Right, good afternoon then everyone as we are at the beginning of another week of trading on Monday the 13th of January. Back to the videos as normal today. I hope everybody, albeit a bit late at this point, but I hope everybody had a good Christmas. I hope everybody had a good New Year and ready for another year of financial markets. A bit going on last week, a bit going on this week, which we'll cover. Last week was the first full week of trading, so it takes a little bit of time for markets to kind of kick into gear, which they did towards the back end of last week. You had NFP last week out of obviously out of the US due to the fact that it's NFP. So, but the US dollar strength off the back of that pretty solid jobs report out of the US keeps ideas of interest rates remaining a bit higher, reduces the need for further interest rate cuts from the Fed, and certainly gives them something to talk about when we come around to the next meeting at the end of this month. Obviously, we'll cover that when it comes to it, but high likelihood no interest rate cut this month. Also, pretty high likelihood we don't even get a cut first half of this year. So, some Fed officials talking about certainly the minutes last week from the Fed, kind of suggesting that they are at the point in which they deemed no further cuts were necessary. They got to wait and see what happens after that. So, um, yeah, a bit of US dollar strength, and off the back of that, bit of a strong jobs report. Then on Friday, again, further compounds a bit of US dollar strength, which doesn't really change much, obviously, for the reasons that we've listed many times last year. They remain heading into 2025 with Donald Trump largely seen as somewhat inflationary. We'll have to see. Remains to be seen what sort of tariffs he starts slapping around the place when he actually gets into office on Monday of next week. So he does get his inauguration on Monday of next week. So last full week of Joe Biden's presidency, that will change then come next Monday, and yeah, we'll have to see what Donald Trump has to say for himself once he actually is formally the president. But yeah, a bit of US dollar strength, interest rates due to remain higher. The central bank seemingly want to continue to cut interest rates, and it's likely that the US dollar stays underpinned, certainly for the time being, especially as yields continue to go higher. A bit of a spike higher off the back of NFP last week, and those trends continue. You can see the 10-year continuing its trend higher. You can see the 2-year continuing its trend higher, and that is positive for the US dollar. But it also drives bond yields kind of globally. Certainly in the UK, they are becoming a bit of an issue. The 30-year yield, the 10-year yield, at extremely high points. That 30-year yield is the highest it's been since 1998. So, well, 20, 25, 27 years really at this point. So, yeah, quite a substantial figure on the UK bond yields. And you had Rachel Reeves over the weekend out in China committing to the budget that they had set out, saying that nothing's changed and that stuff is set in stone. So there's a bit of fiscal worries in the UK, which keeps sterling under pressure, and that is likely to remain. Although she said things would be okay, but with bond yields where they're at, the interest on government debt and also the interest they will have to take on once they decide to borrow more to fund the improvements of the economy that they set out. Again, I'm not going to list through every single one of them, but uh, primarily because I can't remember every single one of them off the top of my head. But also, you get the tax burden in the UK is the highest it's ever been, and you've got to use that tax to try and fund these and then borrow a bit more. So, with interest rates being where they're at, that is not a good thing for the government. Right, you got some inflation worries. Inflation, certainly from a core reading, is still a bit high in the UK. You do get the inflation print. You get inflation prints out on 7 o'clock on Wednesday morning, which we'll have a look at. Couple that with an economy that is not exactly doing too well. 2.3 billion pounds of government debt that needs to be paid, and interest rates on that go up. So, a bit of fiscal worries when it comes to the UK. Bond yields are a problem. Bond yields not just driven by difficulties surrounding the UK. Obviously, that's one reason for it, but also US yields pushing higher is a contributing factor to gilt yields pushing higher. So, definitely something we need to keep an eye on in the coming weeks. Um, Sterling's likely to remain under a bit of pressure, I would imagine. Euro dollar. Last time euro dollar was down at these prices approaching parity, it was massive things made of it. Euro dollar's just chilling down at 102, and nobody's really seeming to bat an eyelid. That's just genuinely the valuation of the euro. 1-on-1 against the dollar. It's not a good thing for Europe. So I doubt you'll see many people from Europe or many people from the UK taking holidays to America anytime soon. But for the Americans to come to Europe, it is a pretty good time for them to come and come and do that. S&P 500, the Dow Jones, the Nasdaq, and the Russell all with downside over the past couple of days. 48 hours worth of trade post NFP, then into today, continuing to move lower. But I can't see a reason why that's long lasting. The S&P down 5.5% from its highs. A bit of jitters when it comes to interest rates remaining higher, but and then no cuts probably the first half of this year. But when you kind of remove that from the situation, once the market get over or once the market gets over that kind of issue, you then turn around and you're like, right, well, the US economy is still performing well. Ultimately, it doesn't really matter where interest rates are while the US economy is still performing well. So you see a little bit of a turnaround over the last couple of hours. Eh, Whether this is the dip to buy back into is another question, but I definitely think try and buy the dip in stocks. US economy still performing well across pretty much every single metric, and as long as that remains the case, then and you gotta keep trying to get long stocks, in my opinion. Brings us on to the calendar. Then you do have CPI on Wednesday, which may get in the way of that. You got CPI on 1:30 on Wednesday out of the US. We'll cross that bridge when it comes to it. Slightly expected to tick slightly higher, but unless that ticks drastically higher, it's really not much to be seen there. So it'll be interesting to see what happens there. Again, we'll cover that more when we get around to it. Other than that, you got inflation out of the UK on Wednesday. I can't see a way in which that's positive, unless it goes lower. Maybe that's something you can look at. But certainly, if that comes higher, that will probably further compound some woes from the UK side of things. But again, we'll cover that on Wednesday when it does come out. But I think if that comes in higher, it might be a slightly troublesome day for sterling. I mean, if it comes in higher, you'd probably expect the pop higher in sterling as it comes out. But again, I don't really see that as a positive. Inflation kind of pushing higher, considering where we're at in terms of the fiscal side of things, with the measures that Rachel Reeves has undertaken, seemingly somewhat inflationary as well. So um, I think that's something worth keeping an eye on. If that does pop higher, you'd have to imagine it's sold back into. I can't see a way in which is that positive for sterling when inflation comes around on Wednesday. I think the unemployment rate. Labour market figures for Australia, I think, are an interesting one when it comes to it on Thursday. Obviously, GDP then goes in line with inflation on Wednesday out of the UK. Some difficulties when it comes to growth again might also be another issue. So um, maybe some action this week on sterling. But that unemployment rate out of Australia, the RBA have not cut interest rates yet. They kind of opened the door back end of last year to start to look at interest rate cuts. If the unemployment rate rises substantially, obviously consensus is for it to rise. If it rises more than that, that will only bring forward the prospect of interest rate cuts. And I think a higher than anticipated unemployment rate, which is negative or weak labour market figures, I think that prompts a better opportunity than anything in the opposite direction. And then I think you look to get short the Australian dollar off the back of that. Maybe you can get some consumer confidence figures this evening to line up with that. If they come in sort of negative, that sets us up pretty well for a bad unemployment rate on Thursday. Again, we do need to wait for these things to align. If it does decide to unfold that way, I think that's where our tradable opportunities come from. So we'll touch more on all this stuff as we go on through the week. But I think long stocks, if you can, whether right now is the opportunity, or maybe you have to wait till after inflation. I definitely think that's an opportunity at some point over the next week, 2 weeks, 3 weeks, whenever that move decides to transpire. Obviously, catching the move is more difficult than just saying it. I mean, easier said than done. But US dollar likely to remain underpinned, especially if yields continue their moves higher. And sterling, I would not be surprised whatsoever to see sterling lower than it currently is by the end of the week. And that euro dollar down at 102, that can easily move 200 pips lower if the US dollar continues to strengthen. So, do we get parity on the euro dollar this week? It's definitely a possibility. So keep an eye on it. We'll update as we go on through the week. But yeah, best of luck trading throughout the course of the week, and obviously best of luck for 2025. So yeah, we're back tomorrow. Have a nice day. Best of luck, everyone, and I'll speak to you all again soon.